Thank you for joining us, and today we're going to look at a trade that might be of interest to you. But before we get started, take a look at the risk disclosure on your screen. If you need to take a screen image of that or pause that, go ahead and do so. Just be aware that past performance is never a guarantee of future results, and that when trading, only risk capital should be used. So here we go. I wanted to point something out, and it's probably obvious to all of you, no secret. Here's this tweet, and the S&P is up 34% in under 8 months. In fact, well, the S&P being higher today, we'd have to update that to, I guess, a little bit higher. And since the October 2023 low, the S&P is up 1,370 points, adding 11.5 trillion in market capitalization. So 1.4 trillion in market cap per month for the last 8 consecutive months. So that means the S&P's return since October 23, since the lows, is now 3 times the average annual return. And just Nvidia alone, that one stock, has added 2.2 trillion in market cap over this same time period. And basically they're saying here that about 20% of the gains in the S&P 500 are just from one stock alone, Nvidia. So phenomenal run here in this skewed, heavily weighted, market cap weighted index right now, whether it's the S&P or the Nasdaq. You can see here the rally we've had. And one other comment right here, the S&P is up, let's see, 14%. This was earlier today, so it's still quite an accurate number. 30 all-time highs just this year. But note that the equal weight index is only up about 3%. So the average small cap stock is only up about 16% in the last 4.5 years. And you compare that to the S&P here, just in the last 8 months, you've seen it up this tremendous amount here. So what could you do? What might your next move be without getting too foolish here? And we're not going to suggest trying to pick a top, but this should be your next trade to consider, at least if you have a large position that you've been long in, let's say the Nasdaq. And we're going to look at ThetaTrader, and we're just going to show you what you might do. You might add some positions here that could effectively provide a bit of a hedge against part of your long portfolio, if that's something you were looking to do, and perhaps take some risk off the table. So we'll look at the bearish tab here. We'll click on the Nasdaq E-mini 100, and we'll just kind of keep it somewhat simple, and we'll look at something called we call a bear hedge. And we'll look at the July week 2 expiration, and the algorithm has already pre-selected these strikes for us and these expirations. And let's drill down and look at the table for some of the details on this position. I'll explain it to you in a graph. It'll make a lot of sense. So here's what it looks like on the graph. So you'd be selling an out of the money call spread. So the 2100 strike is the call that you're selling. And then you're selling, you're buying an out of the money put spread with the money that you've received for selling this out of the money call spread. So use the money that you've received for selling and collecting premium on the call side of the equation, and use it to internally finance the purchase of a long put spread. You can see the market trading right here now, and there's quite a bit of room here, or margin of error, another over 1,000 points before you would be at the money here with these calls that you sold. But ThetaTrader would automatically take you out before then if you wanted it to, and that's something we could show you if you want to check in with us on how to do that. But we call this a bear hedge, and it expires in 25 days, a little bit shorter term in duration. And you'll see here the cash required to place this trade is just under $2,000. And you can see the puts that are being bought and sold and the calls that are being bought and sold. So again, this is the put side of the equation here. That's represented on this graph right here. You buy this put and you sell this out of the money put here, and that's a debit spread, and then here's the credit spread with the calls. And the end result here is you can do this for a price here, 2 3/4 is the settlement value on that. And you'll notice also the delta on the puts and calls that you're being part of the spread here that are being sold. So the puts that you are selling have a delta of 11.7, and the calls that you're selling have a delta of 14.73. But really, the most important part of this equation would be the calls, since this is a credit spread, and this suggests here there's over a 85% probability that these calls that are being sold would expire out of the money. So that's kind of one way to look at delta. And we'll go ahead and take a look. Maybe we'll do 3 of these. Of course, you could change the quantity to any number that you felt suited you best, depending on what you have in your current investment portfolio. But this might be a smart move to make if you think the market's gone a little bit too far too fast, without necessarily trying to pick a top by going short a futures or something like that, where you have that one-to-one movement. So again, this is what this looks like. It's called a bear hedge, and you could go ahead and place that order, and it's just that simple. And thanks for joining us. Just an idea. You might want to consider making a move here to take a little bit of risk off the table if you've been doing well with some bullish positions, and this might be one way to do it. All right, thanks for joining us, and do look at the links below, and you'll note you can sign up for a free demo account and receive free trade alerts. Thanks again. We'll talk to you soon. Bye-bye.